So this is the final topic, which actually I'm wrong here, week 11. Auditors and the sort of very big picture of this topic has to do with the fact that directors manage the company's money, and ultimately that's done for the benefit of shareholders, and they every year need to write a report for the shareholders, and that report is in the form of financial statements, a profit and loss account and a balance sheet, but also, as we have seen, in the form of narrative reporting. So, for example, a remuneration report, but also a strategic report. So when they write these reports, directors have an incentive to show themselves in a favorable light. But that's getting the subjective perspective of the directors on how well they have done is not what the reports are designed to do. They should, in fact, reflect the reality of the company's financial position. So how do you get a realistic report from the directors who have this overriding incentive to show themselves as having done a good job? Well, the answer is bring in auditors. And the auditors have the job of ensuring that this report is adequate or right. And the questions that we need to look at is, can they help? What can be done for this audit to be helpful? And for that, question one is who appoints them, who pays them, and we'll look at the question of competence, independence, and also liability. So here is a big problem here, or a big point of discussion, and that's the audit expectation gap. We're looking at a slide about a carillon, and the information is taken from a parliamentary research briefing on Carillon's collapse. And the problem was, of course, that the auditors signed off on reports that understated the company's problems, that showed the company in a healthy financial position, whereas in fact it really couldn't have been. So that's and that's sort of from that briefing. If we look then at what the auditors do, there's sort of a public expectation that auditors are, carry out an inquiry into how well the company is doing. But that's not really, in fact, what they do. They're given opinion on whether the accounts give a true and fair view of the financial position of the company. So their job isn't to make sure that the company is well run. Their job is more narrow. It's about ensuring that the accounts tell the truth in a fair way about the company's financial position. So that's the main focus of what auditors do. They give an opinion. They do some investigations, and that is, are there adequate accounting records? Do the accounting records agree with the accounts, or are the accounting records then properly reflected in the accounts? And of course, they also talk about the director's remuneration report and say whether that is in agreement with the accounting records. And then they also need to say that they have received all information and explanations necessary for the purpose of this. So here, very important takeaway: the auditors give a view on whether the report is accurate, the financial report is accurate, and the narrative report is in agreement with the financial report. there is two ways in which an audit can go. It can either be an unqualified report saying all's well, or a qualified report saying not all's well, here are the problems. Now, the audit business, the audit activity has changed. It started out as a sort of an activity trying to directly inspect, sampling, taking samples with a view to detecting fraud, and became something that is now more a control, a review of the control systems. So companies have their own control systems, and the auditors go in and see, are these adequate? So that's sort of a development. As we moved over to focusing on control systems, that was also what the auditors were focusing on. Here is a critique of the audit process, and that is the fact that there is an audit encourages us to create processes that are auditable. And that has the disadvantage of that can distract us, the focus on auditable processes, from looking at the substance of a problem or finding a problem. So there's this issue of ritualistic compliance. And that is something that if you focus too much on procedure, you overlook substantive issues. And here is the audit expectation gap on the slide. So the public expects fraud prevention, and the auditors have as their instructions that they need to give reasonable assurances that accounts are accurate. So that's sort of a problem there. Now let's look at how audit is overseen. And there's some exciting stuff going on right now. The Financial Reporting Council will no longer exist soon, and will be replaced by the audit ARGA, I think it's called. Hang on, let me see. Audit Reporting and Governance Authority. There it is. So looking at the Financial Reporting Council, what is the Financial Reporting Council doing? The Financial Reporting Council is the brainchild of a self-regulatory approach. So the idea that the Financial Reporting Council stands on is the accounting and auditing profession regulates itself. The Financial Reporting Council is an umbrella under which this can happen. And so what it does, it sets standards and publishes guidance, and it authorizes supervisory bodies and qualifying bodies, oversees the profession, and inspects the quality of the audits performed in relation to public interest entities. So there's sort of some governmental oversight over these self-regulatory bodies. There's also misconduct investigations, and then very important from our perspective, the Codes and Standards Committee, which is the committee that publishes the corporate governance and the stewardship codes. Now, I mentioned that this is sort of the idea was originally that this would be a self-regulatory space where the profession, having its own interests to be respectable, would be allowed to do that. And the Kingman Review 2018 says this hasn't worked. So they put the spotlight on the Financial Reporting Council, concluding that's an institution constructed in a different era, calling it a ramshackle house, cobbled together with all sorts of extensions over time. And so you can see that these are very strong words. And they're saying it's just serviceable as a house, as a regulatory body, but it leaks and creaks, sometimes badly, and the employees, the inhabitants of the house have sought to patch and mend, but it's built on weak foundations. A new house should be built. So the new house which is going to be a reformed financial reporting council called the Audit, Reporting and Governance Authority, which should have a clear purpose and a mission, be focused on the interests and consumers of financial information on its producers. So that's a statement saying the self-regulation idea isn't a good one. What the authority should be doing is making sure that the product of the report is adequate. So it should be respected by the consumers and feared, literally, by those whom it regulates. So it needs to have the right powers and the resources to do that job and to attract the highest quality people. So quite an aspirational statement for this new authority to oversee the audit and auditors. So that's sort of, this is here about the regulator for the profession. And this is about, the Bryden Review is about what the audit should be doing, how to audit, what the financial information should be about. So the Competitions Markets Authority and the Kingman Review focused on the audit market, and Bryden focuses on what should be the value of the audit process. And so that goes towards this audit expectation gap. Is the audit about ensuring the report is accurate? Because that's a very much sort of a backward-looking exercise. So they look at what happened in the last year. Is the final year statement a true and fair representation of the final year's financial position? When in fact, we would like to know a bit more about what the prognosis is. So Bryden says the result of this audit should be more useful and perhaps more forward-looking. And that's sort of a clear public interest. Now, another problem that has troubled auditors, in addition to this question of, is the regulator adequate? Are the instructions of what auditors should be doing adequate? Are they sufficiently independent? And that came out of Enron, really, where the auditors, Arthur Andersen, were very close to the company, to Enron, and they had members sitting on the board, and there was too much of a connection between them. So the mechanisms following Enron, and here you see some examples, there's been quite a bit of regulatory activity on ensuring independence of auditors. And the rules are fairly granular and detailed. So then there's a question of competence. So one is the independence. The other wing of ensuring audit quality is competence. There's two ways in which competence pans out. Firstly, qualifications, so an adequate system of licensing auditors, and then, of course, rules on accessing information. So a requirement for the company and its officers to give information to the auditors, and then provisions protecting whistleblowers. So giving them some privileges, encouraging whistleblowing. So we've got, in terms of our main aim here is to ensure a robust audit, and how to incentivize auditors to do a good job. So the Bryden Review is about working out what is a good job, like what would be a useful contribution by auditors. The Kingman Review is about ensuring how to best oversee the auditors so that they are incentivized to doing a good job. And then one way of achieving that is ensuring they're independent. Another way is ensuring that they're competent. And a third motivational factor is making sure that when they're not, they're liable. And the idea is that there's a prophylactic element in liability, because if you know you're going to be liable, perhaps you will be more focused on doing your best when you carry out an audit. So here is liability, and the general approach in the UK is that liability rules exist, but they aren't very strong. So there is liability towards a client, so that is liability to the company who commissioned the audit. But there already we've got a recent case where the causation rules meant that there is no liability. The Grant Thornton case, it's very, very dense case, and because causation is a difficult topic, but there it was held that the auditors weren't liable for the dividends that the company paid because the director's decision intervened as a causative event, and then the auditors therefore were relieved from liability. And here's more on the client liability, and we can generally see that the client liability rules aren't very, so they exist, but they are sort of undermined by the difficulty of establishing causation. And then talking about third-party liability, under the rule in Capara and Dickman, there's only liability against a third party if the auditor themselves has assumed responsibility to that specific third party. So there's no liability there. So context again, we've spoken about the liability as a motivating factor, incentivizing high quality audit. And the takeaway from the UK is that the liability rules aren't very strong ones. So there's liability only towards the company, and only in very special circumstances towards a third party, like a shareholder or a lender. And for the company liability, causation is a significant barrier to auditor liability. And then, of course, there's professional liability. And there, the Financial Reporting Council, I think in fairness to them, has become more active recently. And professional liability occurs in the form of a fine, in the form of a reprimand, which is sort of a telling off. In the worst case, auditors can be struck off the register, and of course, a public disclosure of sanctions. So here, and this is a wonderful topic really, because there's so many ideas right now out in the space. Questions: what can we do and so again, the overall goal is to ensure that audit is a useful add-on, a useful contribution to corporate law. And the first question is, what is that? So what would be useful? And Bryden has said what would be useful is more forward-looking. And then, given we've established that, how can we make sure that auditors produce this useful contribution? So, for example, should auditors be appointed not by the company, but by the audit authority, the ARGA? Or should the audit committees of the company be more robust? So should there be special qualifications? Should they have to have write reports to the audit authority? Should there be observers on an audit committee? Or should there be public reprimands of audit committees that haven't done a good job? Another idea is joint audits, have more than one auditor. Another idea is have hot peer reviews, meaning bring in an auditor to an audit process on an ad hoc basis, just overseeing this. So have an inspector of the inspector. This is a point about the fact that there's not much competition in the market for large audits. Maybe there should be market share caps. Here is another idea. Should we further enhance independence by splitting audit from non-audit work? Should we defer the remuneration of the auditor? Or maybe allow audit firms to grow by allowing non-auditors to hold the majority in those firms, because the current problem is not many auditors, not much competition between them. They have no incentive to be particularly sort of active or to sort of impress their clients because there's no competition. So maybe we allow medium-sized firms to grow by allowing an investor from outside the audit profession to join the firm. Another idea is to require the large auditors to license their technology, to share their know-how, or to disclose the staff hours of the partners and the firm on the particular audit. And maybe then another idea to tender every 7 years. So the main thought process that you need to go through is asking yourself, what's the role of the audit? And then coming up, knowing what the individual, what in the UK have been the measures implemented to ensure that auditors perform that role, and then asking yourself going forward, is that good enough? The Kingman Review has said it's not, and has come, and here are some ideas. The Bayes Committee is the committee in Parliament, and the CMA is the Competition and Markets Authority.